Okay, so hello guys, today we're going to talk about MFRS 15 revenues from contracts with customers. Let's begin with why MFRS 15 exists. It's because previous revenue recognition requirements provided limited guidance. Next, let's move on with the objectives of MFRS 15. The objective of this standard is to provide a single, comprehensive revenue recognition model for all contracts with customers, which helps in improving comparability within industries, across industries, and across capital markets. Now, let's move on with the core principles of MFRS 15. Alright, the core principles of these standards is that an entity shall recognize revenue to depict the transfer of promised goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods or services. Now, an entity shall apply these standards to all contracts with customers except lease of contracts, insurance contracts, financial instruments, and also non-monetary exchange between entities in the same line of business to facilitate sales to customers or potential customers.
Next, let's take a look at a 5-step model, which consists of first step, identify contracts with customer, step 2, identify separate performance obligations in the contract, step 3, determine the transaction price, step 4, allocate the transaction price, and step 5, recognize revenue when the performance obligation is satisfied. So, what is a 5-steps model? First-step model is the core principle of MFRS 15 is that a revenue is recognized when the goods or services are transferred to the customer at the transaction price. Revenue is recognized in accordance with the core principle by applying a 5-step model. Now let's take a look at step 1, which is identify contracts with customer. A contract creates enforceable rights and obligations. It may be written, oral, or implied by customary business practice. Combined contracts, when they are entered into at or near the same time and are negotiated as a package payment or one depends on the other, or goods or services promised, are a single performance obligation. A contract modification is accounted for as a separate contract or continuation of the original contract prospectively or with cumulative catch-up, depending on facts and circumstances. Next is step 2. Identify separate performance obligation in the contracts. Performance obligations are promised in a contract to transfer goods or services, including those the customer can resell or provide to its customer. Use the model's indicator to separate the performance obligation if they are capable of being distinct and if they are distinct based on the context of the contract, if it's separately identifiable from other promises in the contract. Next, step 3. Determine the transaction price. Transaction price is the amount of the consideration a company is entitled to receive in exchange for transferring goods or services to customers. Determining the transaction price is straightforward when the contract price is fixed. It becomes more complex when it is not fixed. Discounts, rebates, refunds, credits, incentive, performance bonuses, and price concussion could cause the amount of consideration to be variable. In situations where there are various considerations, transaction price is estimated based on the expected value or the most likely amount, but is constrained up to the amount that is highly probable of no significant reversal in the future. The minimum amount that meets this criteria is included in the transaction price. Step 4. Allocate the transaction price. Transaction price should be allocated to distinct performance obligations based on relative standalone selling price. This may be the standalone price of goods or services when sold separately to a customer in a similar circumstances and to similar customer. If a standalone selling price is not directly observable, estimate it by considering all information that is reasonably available, such as market conditions, specific factors, and class of customers. And lastly, step 5. Recognize revenue when the performance obligation is satisfied. Recognize revenue when the promised goods or services are transferred to the customer and the customer obtains control. This may be over time or at a point of time. The new standard provides indicators when control is transferred. Additionally, the new standard introduced a new concept and revenue is required to be recognized over time when the asset being created has no alternative use to the company and the company has an enforceable right to payment for performance completed to the date. So, what are some of the key changes of the implementation of MFRS 15 towards the accounting perspective? First is the allocating of the bundle sales. Additional revenue may need to be allocated to discounted or free products provided at the beginning of a service. Revenue recognized may no longer reflect billed revenue. Next is contract cost. MFRS 15 is likely to affect the accounting treatment of customer acquisition costs and certain contract fulfillment costs. In addition, is profiling contracts into portfolios. Companies may apply MFRS 15 to a portfolio of contracts or performance obligations. They need to be mindful though, as this approach may create additional implementation challenges and complexities. And finally, is timing of revenue recognition. Identifying performance obligations are key to determining when revenues can be recognized, whether over time or at a point in time.
So now let's talk about the MFRS 15 issues and challenges. So there are three industries, which is construction, telecommunication, automotive. So we talk about construction industry for the first time. So the contracts in the construction industry include designs and building houses, parking lots, security maintenance services, etc. The contractor provides a significant integration of the goods and services to their customers by incurring the cost of contractors and sales commission. Such contracts are agreed upon the completion of the house. However, in the Malaysian scenario, the contracts often are agreed before the completion of the house. The contractors need to consider the following: whether the revenue is to be recognized progressively over time, or which method can be used at what stage of the completion. So now let's look at the example of this construction industry, which is Sansuria Berhad negative impact. So the negative impact that we are going to talk about is the article which says that Sansuria Berhad reported a net profit of 11.8 million for its fourth quarter ended September 30, 2019, which went down to 86.9 million on the year from 84.6 million, mainly due to the effect of the company's adoption of the financial reporting standard MFRS framework at the beginning of its financial year. So basically quarterly revenue was down to 61% at RM 104.81 million, lower by 61% compared with 273.57 million in the year 2018. So that is all for the construction industry. Now let's move on to the next one.
Next, let's move on to the issue and challenges of MFRS 15 in the telecommunication industry. Telecommunication industry is probably one of the industry that is most affected by MFRS 15. The telco industry usually provide a service plan like 12 or 24 months contract with the device. They are also providing upgrades to the plan including roaming passes, weekend data, pocket Wi-Fi and others. This telco provider usually having problem in allocating the transaction price of the goods and services. When there is a contract between two parties, it actually consists of multiple performance obligation. A performance obligation is a promise to provide a distinct good and services to a customer. Before POs could be identified, the finance department had to spend significant amount of time with the respective product owners, marketing, and other departments to understand the features of the service plan in detail. At the same time, product owners and the marketing department were struggling to grasp the fact that freebies thrown into a plan could potentially translate into a separate POs, with a price attached to it under the new revenue standard. As identifying POs was not challenging enough, allocating the stand-alone selling price, or called as SSP, to the POs was another hurdle. So, what is SSP? SSP is the price which the entity would sell a good or services separately to a customer. It usually estimates the price that the customer would pay for the good or services in the entity's market. In most cases, there wasn't a single standard price, and determining SSPs often involve a significant amount of judgment. So, how should telcos price 1 GB of data versus 15 GB of data? How should they price for the free data content? The problem that is usually faced by the telco companies are how to allocate revenue related to the distinct good or services, whether the revenue is to be recognized one time or at the point of time, whether the revenue need to be adjusted in order to account for the value of money, whether the costs relating to obtaining a contract need to be capitalized or otherwise, how to account for the contract modification. But there are also a positive impact on the telecommunication industry in applying MFRS 15. Based on the article of Most Analysts Neutral on Telecommunication Sector, it stated that there is an increase of 4% of net profit quarter on quarter due to the MFRS 15 on the postpaid device revenue, dealers' commission and amortization, especially for Maxis and DG. Other than these two industries, automotive industry also are affected from this implementation of MFRS 15. The automotive industry in Malaysia is very competitive. Automotive giants have been declaring war against one another by claiming they are offering the best deal in town, whilst trying to maintain their margin. In automotive industry, usually they are facing the problem in delivering goods or services to the customer. In previous year, we can see that the delivery of goods or services is providing extended warranties, free services, and discounts or rebate to their customer in competing in the market. Basically, in the automotive industry, MFRS 15 requires them to allocate transaction prices of the vehicles being sold into the individual goods or services being promised to the consumers. This involves identification of performance obligation and assessment of the stand-alone price for each performance obligation. Whether or not a promise is a distinct performance obligation is subject to discussion based on facts and circumstances. Once the performance obligation is identified, the transaction price is allocated across based on the respective standalone selling price, or also known as SSP. Normally, automotive industry is facing the problem to record the transaction price for the maintenance services to maintenance department and sales goods or services to the sales department. The question came up is that what would be the impact of the standard on the pricing mechanisms such as variable amount? Second, how to account the distinct vehicle and maintenance services offered. Third, whether the revenue needs to be recognized over time or at point in time. And the fourth one is how to account the different types of warranty coverage offered to the customers. The issue that we have found out from the article of MFRS 15 implementation challenges in the automotive industry. It shows an example of the problem faced by them. As automotive players normally sell bundled goods and services in a package, the SSP may not be directly observable. When SSP is not directly observable, significant judgment will be needed to estimate the SSP. For example, Mark purchased a vehicle with a free service and a warranty package from automobile company. Based on the package, Mark will get free services up to 3 years or 60,000 kilometers, whichever comes earlier, a standard warranty package of 3 years and an extended warranty package of 2 years. In addition to the free service and extended warranty package, Mark also was given free dinner vouchers to dine at luxury hotel. The SSP of the free service and extended warranty are not observable in the market as they are not sold separately. As such, automobile company has used the cost plus a reasonable margin approach to derive the SSP of the free service and extended warranty package at RM1,500 and RM3,600 respectively. However, the SSP for the free dinner vouchers were estimated at RM100 based on its standalone selling price. The impact of MFRS 15 can be seen at the shown table. As you can see, the allocation of transaction price of SSP have a significant higher value than the allocated revenue, which is by 5,200. In conclusion, the application of the 5-step model in MFRS 15 requires significant judgment to be made. The implementation also requires input from different divisions within a company and not the finance division alone. Understanding of the standard by the affected parties is a crucial factor for a successful implementation of this standard.
Thank you everyone.